Hello there. Welcome to FM with Sir Evans. In today's session, we will discuss the fourth competency in the syllabus of ICA Paper 2.4 Financial Management, and that is Investment Appraisal Techniques. Let's get started. So entities have two options of expenditure, either a capital expenditure or a revenue expenditure. A capital expenditure is a spending on non-current assets such as building and equipment or investing in a new building. Revenue expenditure, on the other hand, refers to expenditure that does not create long-term assets, but is either written off as an expense in the income statement in the period that it is incurred, or that creates a short-term asset, such as a purchase of inventory. Now, investment appraisal is the evaluation of proposed investment projects involving capital expenditure, and it meets two criteria. The first one being provide a suitable financial return, and the second one is investment risk is acceptable. Now, many companies have a capital budget, and capital expenditure is undertaken within the agreed budget framework and capital spending limits. These budgets should be reviewed and updated regularly, typically each year. So investment appraisal takes place within the framework of a capital budget and strategic planning. So investment projects have certain characteristics, which we'll look at. The first one is that it involves the purchase of an asset. So there is a payment of a large sum of money at the project start, and it generates returns in the project life. The second one is that the asset might have disposal value at the end of its useful life. So it will need working capital investments. Example, cash. Okay, so there are certain methods of investment appraisal which we'll be looking at, and each of these methods has respective basis for making the decisions that are made. So one of them is the accounting rate of return. So this is a financial accounting basis. So the reason for making a decision using the ARR is financial accounting basis. So the second one is payback method. So this is for cash flow reasons. Discounted cash flow method, the net present value method, creates an additional value in the business. So the decision is based on the additional value that comes to the business. Internal rate of return. So this is also this helps in making a decision on whether a particular investment is provides a good investment return. And then discounted payback. So this one has cash flows which have been discounted over time to tell at what point we will be able to cover our initial investment. Aside all of these reasons, there are certain non-financial factors which are non-monetary in nature, and they are considered in making the investment decisions. So these non-financial factors are to a large extent situational. So based on the situation the entity finds itself, they need to make its decisions. So one of such is, does the appraisal technique fit the corporate objective? So some of the risks, what are some of the risks that are associated with this investment? And does the investment fit with our existing investment portfolio? What will be the impact of new investment on our wider business, on our stakeholders, i.e. our customers, our employees, shareholders, community, and even its impact on our reputation? Those are some of the non-financial factors which we would want to consider. So Johnson and Scholes have a model which is known as the suitability, feasibility, and acceptability model. And this model is used in corporate strategy to appraise strategic decisions. So the first model, suitability, is concerned with whether it will achieve its intended purpose. So some projects do not necessarily achieve a return that is measurable. So we are looking at its intended purpose. So two, feasibility is concerned with whether it will work or it can be implemented successfully. So under feasibility, some of the questions that we should consider is there sufficient finance for the project? Can we afford that project? Do we have the employees with the necessary skills to implement the project successfully? Can we even obtain the raw materials that will be needed to implement the project? Is our IT good enough to implement the project? The third one is acceptability. So it's concerned with whether this will be acceptable to the key stakeholders. So examples of questions you may ask is that, does it provide an acceptable return? How will it affect our customers, our employees, our local community? So an investment might be undertaken with a view of sometimes ensuring that our shareholders' value is maximized, but then it may not have a clear link to a financial outcome. So for Johnson and Scholes model, we are looking at the relation between the suitability, feasibility, and acceptability of that particular project, and we make a decision based on that. So the first model we would want to look at, the first method of appraising our investment, accounting rate of return, is what we want to look at now. So the accounting rate of return from an investment project is the accounting profit, usually before interest and tax. So we consider the profit before interest and tax as a percentage of the capital investment. And this is similar to the return on capital employed, ROCE. So to make a decision on your accounting rate of return, you need to accept when the expected accounting rate of return is higher than a minimum acceptable target. So there is a set target and your accounting rate of return for the project must be higher than that. So we have a formula here. So to find the capital employed, it is the initial cost of the equipment plus the residual value divided by 2 plus your working capital. And then to get your accounting rate of return is the average annual accounting profit divided by the capital employed multiplied by 100. So when you do it this way, you are going to get the accounting rate of return, which you will compare to your benchmark ARR, and you select when it is above it. So the accounting profit, we should be mindful, is the profit after depreciation before interest and tax. Okay, so accounting profit. We'll look at an example now. A company is considering a project which requires an investment of 120,000 in machinery. So that's your initial cost of equipment. The machinery will last 4 years, after which it will have a scrap value of 20,000. So that's your receivable, your residual value. Now the investment in additional working capital will be 15,000. So with this information alone, we can determine our capital employed. So the expected annual profits before depreciation are 45,000, 45,000, 40,000, and 25,000. So these are profits before depreciation. But then we need to determine the depreciation of the asset throughout its life so we can get the profit after depreciation. So the company requires minimum ARR of 15%, and ARR is measured as an average annual profit as a percentage of average investment. So to find our ARR, we need to find the average annual accounting profit. So to find the accounting profit, you sum up all your profit before depreciation, and then you less it by the depreciation of the asset. Now the cost of the asset minus the scrap value gives you 100,000, which is what will be depreciated throughout the life of the asset. So you deduct this 100,000 from the total profit before depreciation. You divide that by 4 to find the average annual profit, and that becomes what you put into your ARR formula. And when you do that, you are going to get an average annual accounting profit of 13,750, capital employed of 85,000, ARR of 16.2%. When you follow the Telegram channel, you will be able to have access to the slides and the marking scheme, so you'll find a detailed computation of this particular example. We'll move on to some of the advantages and disadvantages of ARR. So some of the main advantages of ARR is that, one, it is fairly easy to understand. So the concepts are familiar to business managers, such as the profits and then the capital employed, which is being used. Two, is also easy to calculate. Now, some disadvantage is that it is based on accounting profits and not cash flows, which are normally the objectives of our investment. Two, its accounting profits, it ignores the timing of accounting profit. So it doesn't mind when it was being, that accounting profit was made. And three, we have a percentage a percentage return being what we are getting at the end of our ARR computation. So it relates the average profit to the size of the investment. Hence, it doesn't give an absolute return, like how the NPV gives you an absolute amount being added to the value of the entity. This gives you a percentage return, which is sometimes and being unable to determine exactly what it is. So it's also a decision that has to be made using the minimum target ARR with no rational economic basis on how to set that particular minimum ARR. Thereby, it makes it a subjective target. And then the accounting profits are often an unreliable measure because they can be altered by change in estimates such as the depreciation rates and residual value. So because of that, it becomes an unreliable measure. We move to relevant costs. So relevant costs and benefits are those future cash flows which are arising as a direct consequence of the decision under consideration. So based on that particular decision, what cash flows are going to come? So relevant cash flows are cash flows. So any item, of course, that are not cash flows are often ignored for the purpose of that decision. So example, depreciation is ignored when we are looking for relevant cash flows. Relevant cash flows are also future cash flows. So those that have already been incurred are not relevant to a decision that is made currently. And then relevant costs are costs that arise as a direct consequence of the decision, even if they are future cash flows. So those that are direct consequences of our decision form the relevant costs. So we'll look at some more examples of relevant costs. So we have relevant cost of existing equipment. So when you purchase, the purchase cost of a new capital equipment is relevant. So if the existing is also high, if it's existing, then the relevant cost is the higher of the current disposal value and the cash flows, the present value of the current cash flows, those become relevant. So we also have the relevant cost of material. So the future purchase costs of those materials that are purchased for the project are relevant. And if the item is already in stock, then the current replacement cost for those in regular use. So the current replacement cost of those items which are regularly used, that is also relevant. And then if the item is in stock, but it's not regularly used, then the higher of the net disposal value and net contribution from another use becomes our relevant cost. And go to relevant cost of investment in working capital. So the investment in working capital is not a cash flow, but is treated as a cash flow because actual cash flows often differ from the cash profit due to movements in working capital. So an increase in working capital is treated as a cash outflow, while a decrease is treated as a cash inflow, so that we can be able to adjust our cash profit to the expected cash flow for the year. And then we go to opportunity costs. These opportunity costs are the benefits which are foregone by using the assets or resources for one purpose instead of using them in the most profitable alternative way. So they are commonly measured as a contribution foregone, but might not be measured as a present value. So when resources have more than one alternative use and are in limited supply, their opportunity cost is the contribution foregone by using them for one purpose, and so being unable to use them for another purpose. Then risk. So risks exist whenever a future outcome or future event cannot be predicted with certainty, and then a range of different possible outcomes or events might occur. So that situation of being uncertain poses certain risk. Now, risk can be divided into one. We have the pure or downside risk. So with this one, there's a possibility that an adverse event will occur. So events might turn out to be worse than expected, but they cannot be better than expected. But then they can also be controlled by internal controls or insurance. Speculative or two-way risk. So the actual future event or outcome might be either better or worse than expected. So an investor in shares or company faces this type of risk based on the changes in the conditions. They cannot be avoided, and must be taken so that we are able to make some profit. So as a general rule, higher risk should be justified by expectation of higher profits. So though it may turn out to be worse. Now, the risk attitude of an organization is the general approach to risk, and it influences whether or not risks are taken, whether they are tolerated, they retained, shared, reduced, or even avoided. So risk management goes a long way in the management of the downside risk and also the business risks that are being posed to the entity. This risk management is the process of managing both the downside risk and the business risk. This is defined by the culture of the organization, the structures, the processes that are focused on achieving possible opportunities, and at the same time to control any unwanted results. So any process of risk management would include three elements. So the first one is risk identification, which involves understanding what the risks are faced, both strategic and internal. Then risk assessment, which is also called risk profiling or risk mapping, and it considers the likelihood that losses will occur as a consequence of the risk and the size or amount of the loss when it happens. Now, risk control, the suitable control measure which we will select, it will depend on the significance of the risk and the cost of taking that measure. So the cost must be less than the benefit to be obtained. So approaches of risk control are, one, we have the risk transfer where we pass some or all of the risks to others. Example is insurance. We have hedging risk where we create a position that offsets an exposure to another risk using derivative instruments such as futures, options, and swaps. And we have diversification where we are spreading our risk by investing in a range of different business activities and build up a portfolio of different business activities. Now we will look at something we call the discounted cash flow and taxation. So discounted cash flow and taxation looks at the impact of taxation on our cash flow when we are doing discounting, bringing it to the present value. So interest costs are not allowable expenses for tax purpose. Therefore, present values are estimated using post-tax cost of capital. And the timing of tax payments on cash flows are often also considered. And also tax savings on tax allowable consideration is considered as a cash inflow. So our tax allowable depreciation, we find a tax component on that and it becomes a tax savings, which is considered as a cash inflow in our analysis. So tax allowable depreciation, which is a capital allowance, it affects the cash flow from an investment, and the tax effects are included in the project cash flow. So tax could be allowed by the straight line method or the reducing balance method. So we'll look at one example. An asset costs 80,000 and has an expected economic life of 4 years with no residual value. So the tax on profit is 25%. Let's find a tax savings. So each year we are going to depreciate this asset it's going to be 4 years. So the cost is 80,000 divided by 4 years. So 20,000 becomes the amount which is going to be depreciated each and every year. And when we find the tax on that particular depreciation, 25% on that particular depreciation, then what we are saying is that 5,000 becomes a tax saving for each and every year. So for the 4 years, we are going to have 20,000 as our tax saving. And the second one, an asset costs 80,000, tax allowable depreciation is 20% on a reducing balance method. So with reducing balance method, you need to, at the end of the first year, when you depreciate it, then the second year, you find the net book value, which is your cost minus the prior year's depreciation or accumulated depreciation. And then you find the tax savings on that particular one. So when you do that, you find that the tax savings is 13,446 for the whole 4 years. So the tax savings are treated as cash inflows in the appropriate year in the discounting factor analysis. So either in the same year that the allowance is claimed or 1 year in advance. And there is a balancing allowance or charge, which is the remaining amount in the last period. So discounted cash flow and inflation. So inflation is incorporated in a discounted cash flow analysis by either discounting the money cash flows at the money cost of capital or discounting the real term cash flow at the real cost of capital. So we have real terms here, we have money terms here. So we have this formula which will help you to do the conversion. So 1 plus M, 1 plus R, 1 plus I, where M is our money cost of capital, R is our real cost of capital, I is our inflation rate. So we need to determine if our cash flows are real cash flows. Then we need to have a real cost of capital. If our cash flows are money cash flows, then we need to have money cost of capital. And this formula will help us to do that conversion. Okay, so real terms, when we say real terms, what are the real terms? So real terms are cash flows. Real term cash flows are what an item would cost or be sold for in the current prices. So before considering inflation, what are the current prices that the particular item will be sold or bought for? Whereas money cash flow refers to the amount that is actually received or paid at different points in time in the future. So real cost of capital is the return that investors will require without inflation. And money cost of capital is the return that investors will require with inflation. I go to capital rationing. Capital rationing occurs where there are insufficient funds available to invest in all projects that has a positive NPV. So where projects have positive NPV, we are pretty excited because we are going to have more value to the entity, but then we may not have sufficient funds to be able to engage in that. Therefore, we do capital rationing. So we have the hard capital rationing, which occurs where there is a real shortage of capital for investment. So for example, a company might be unable to raise new capital in the capital market or borrow large amounts from a bank. Thereby, its capital for investment might therefore be limited to the amount of capital it adds to the business each year as cash flow from retained profit. And we have soft capital rationing, which occurs where there is sufficient capital to invest in every project, but management has taken a policy decision that spending on capital investment should be limited to a budgeted maximum amount. So the policy decision therefore sets a limit to the amount of capital available. So when you are into capital rationing, we are solving two types of problem. We have the single period capital rationing, where the projects are freely divisible and the capital is in limited supply for one time period only and freely available in other periods. So fully divisible projects with positive NPV are often selected, and there's highest profitability index, which is to find profitability index is the NPV divided by the capital investment. So projects with the highest profitability index are selected up to the available cash for single period capital rationing. And then the other situation is single capital rationing, where projects are indivisible. They are indivisible. So part investment is actually not possible. So you select the project with the maximum NPV within the available capital limit. So that's a second scenario. The first scenario is where the projects are divisible. Second scenario is where they are indivisible. And we have a multi-period capital rationing where the projects are freely divisible. And then the limitation on our capital is spread across multiple years. So with this one, there is linear programming, which will be used to identify the NPV that maximizes the combination of the projects. So lease versus buy decisions. So these are decisions whether or not to acquire a new non-current asset, and if the asset is acquired, whether the acquisition should be financed with a bank loan or by a lease arrangement. So this is also considered in two stages. So the first stage is the acquisition or investment decision. So you need to decide whether or not the asset should be acquired. And this decision is based on the assumption that the assets will be purchased. And then the financing decision, you need to decide the preferred method of financing the acquisition by buying for cash, using loan, or leasing it. So types of lease, we have finance lease, which transfers substantially all the risk and rewards incidental to ownership, and operating lease, which does not transfer substantially all the risk and rewards incidental to ownership. So the acquisition decision, in making the acquisition decision, you reach this using the normal NPV method of investment appraisal. and cash flows include purchase costs, expected benefits and costs, residual value and tax savings after tax cost of capital is applied as well. And for the financing decision, the financing method with the lower PV of course is selected. So the relevant cash flows will include the purchase price of the asset, the tax savings if it's bought, rentals if it is leased, tax relief on rentals, disposal proceeds if it is bought. So that's the two stages you go through and the methods to use. Now, asset replacement decisions is involved deciding how frequently a non-current asset should be replaced when it is in regular use, so that when the asset reaches the end of its useful life, it will be replaced by an identical asset. So the decision rule is to select the least cost replacement cycle as it minimizes the PV of the cost. Relevant cash flows that we need to consider are the cost of the asset, the maintenance, the operating cost, the tax relief on the running cost, and then the tax savings, the scrap or resale value. Now, equivalent annual cost method. So for this one, for each choice of the replacement cycle, the PV of the cost is calculated over one full replacement cycle with asset purchased in year 0 and disposed at the end of the cycle. So the PV of cost is then converted into an equivalent annual cost or annuity. So the equivalent annual cost for replacement for every n years will be equal to the PV of cost over one replacement cycle of length n over the annuity factor, and the lowest equivalent annual cost is selected. So risk exists when the actual outcome from a project could be any of several different possibilities and not possible to predict which will actually occur. So that is uncertainty. So probability estimates can be used to measure the risk and evaluate it mathematically. Then uncertainty exists when there is insufficient information to be sure about what will happen or what the probability of different possible outcomes might be. So to analyze and assess the risk and uncertainty, we use sensitivity and probability analysis in our aid to do that particular analysis. So sensitivity analysis assesses how the NPV of the project might be affected if cash flow estimates are worse than expected. So it's a what-if analysis to calculate the effect on NPV for either percentage reduction in benefits or increase in cost. So percentage amount by which cash flows could change before the project NPV is changed. And then the change in cost of capital can also be found by calculating the project IRR. Now, this sensitivity analysis is useful because it directs management attention to the critical variables in the project. A major problem is that only one variable is varied at a time, though they may ideally be interdependent. So we pick each variable and we determine what happens to our NPV when there is a change. Expected value is a weighted average value, which is calculated using the probability estimates of different possible outcomes. So to calculate probability of each possible outcome is estimated and the average outcome is calculated. Therefore, expected value is equal to the sum of Px, where P is the probability of each outcome, X is the value of each outcome. And when assessing risk in capital investment appraisal, X will be the NPV for each possible outcome. Now, the decision rule is that projects should be undertaken if the expected value of NPV is positive. However, if the risk involved is too great in relation to the expected return, then NPV may be positive, but it wouldn't be undertaken. Now, the advantage is that it's a weighted average measure of all the possible outcomes, and it provides a single figure and not a particular range. Now, a disadvantage is that it's subjective when you are estimating the probabilities. So the EV or the expected value of NPV may not happen. And it's also not suitable for one's only capital project, as EV may not provide an analysis of the project risk. Then we go to joint probability, which is a probability that two things will happen together. So probability of A and B will be probability of A multiplied by probability of B. The probability A or B is the joint probability that both A and B will happen. Probability of A is a probability that A will happen, and B is a probability that B will happen. So this refers to the investment appraisal methods we engage in. I want to thank you for staying with me to the end. Kindly follow the link below to join the Telegram channel for the slides, the Telegram channel for the paper 2.4, where you can have access to the slides, a marking scheme to all examples discussed in the session, and other relevant materials that will aid you in your preparation. Thank you once again, and see you in the next session.